Some Canadians, to save on taxes, are looking to move to tax-friendlier countries. So how does that work with your investment portfolio? Fasten your seatbelts, folks. This is going to be a good one. Maybe you're considering a move from Canada to another country, or perhaps you've already unpacked your bags in your new tax haven. Whichever is the case, understanding how your Canadian investment accounts are treated abroad, well, it's very, very important. In this video, we are going to explore some of the complexities of managing and, well, the taxes involved in your favorite accounts, such as your TFSA, RRSP, or even in your non-registered accounts. It is important to gain an understanding on your new, or, well, soon-to-be new tax situation. Obviously, this will help you not only remain compliant with current tax laws, but it also helps you get the most out of your investments. We will be exploring these taxes mostly from the Canadian perspective, so it should go without saying that you also want to check with a local tax expert on any tax considerations coming from your new country. Join today's conversation. Let me know in the comments if you have plans or already have relocated out of Canada to save on some of those pretty hefty Canadian taxes. Thank you for your participation. If you love this sort of content, be sure to subscribe for more. And another huge thank you for that click. We are going to begin with the tax-free savings account, or TFSA. This account, which was created by the government in 2009, is a huge favorite with Canadians for not only its overall flexibility, but for the fact that it allows your investments to grow tax-free. That's not too shabby. This tax-free status of the TFSA is recognized under Canadian tax law, but that does not mean other countries will recognize it in the same way. One great example is that if you decided to move south of the border down to the United States, they view your TFSA as a foreign trust. This means the income earned in that TFSA while you live in the US is considered taxable income by the IRS. Additionally, you are unable to apply for a foreign tax credit because, well, that growth in the TFSA is not taxed by Canada. Another completely different example is Costa Rica, where they only tax local income for non-residents. Thus, all foreign income is tax exempt, so your TFSA maintains its tax-free status. However, and I gotta throw this in, if you become a tax resident of Costa Rica, it is different, as they will then tax your dividends and capital gains within your TFSA. Typically, you become a tax resident if you live there for 183 days in a fiscal year. Some folks have found workarounds, but I'll leave that to you and your local tax professional to work out those details. It becomes very easy to see that when planning that exodus from Canada, you want to find out the tax treatments of your destination. Another key point with your TFSA is that as soon as you become a non-resident of Canada, you're no longer able to make further contributions into it. In fact, if you give it a try, that contribution will incur a penalty tax of 1% per month of the amount you added, not of the whole TFSA, but just the amount that you added. Your contribution room, it does not grow once you become a non-resident. But if you do, of course, return to Canada, it will start to grow again as you regain your Canadian resident status. Let's move on and talk about your Registered Retirement Savings Plan, or RRSP. This is a great tool Canadians can use to defer taxable income into their retirement, when theoretically they should pay less taxes on that income. The story this time is a little better, as unlike the TFSA, a lot of countries do recognize the RRSP. This, of course, is due to many of the tax treaties Canada has with a lot of different countries. In Canada, the investments within your RRSP are only taxed when you withdraw them. This is often the same case in other countries. So if we revisit the United States, who has a tax treaty with Canada, the RRSP is treated the same and is taxed as income as you pull investments out of that retirement account. In Costa Rica, though, they do not have a tax treaty with Canada, so it is a bit different. When you make a withdrawal, a 25% withholding tax will be applied, and that is sent off to Canada. Well, the CRA, to be more specific. You can file a foreign tax credit to ensure that you are not getting taxed twice, which is good. When it comes to contributing to your RRSP, you can still do that as a non-resident if you have earned income in Canada or carry forward contribution room. However, However, you still want to check with local tax rules as well. They could still hit you with some local taxes on that income. For normal withdrawals, there is still a withholding tax of 15% in tax treaty countries like the US. In that example, you would report the income on your US tax return as foreign income. You would then claim a foreign tax credit so that you are not taxed by the IRS on the money that has already been taxed by Canada. Nonetheless, you still want to check your individual state tax rules, as there can be a few differences depending on which state you are living in. There are other registered plans you could have, such as the Registered Disability Savings Plan or the RDSP. RDSPs are unique because they involve contributions matched by Canadian government grants and bonds, significantly enhancing the growth potential of those accounts. While the RDSP itself can remain open regardless of where you live, contributions and government grants are contingent on Canadian residency. For non-residents, maintaining contributions isn't possible, and previously granted government contributions may need to be repaid if residency requirements aren't met. Moreover, each country can have different views on foreign disability savings accounts, which may affect how they are taxed or assessed abroad. Withdrawals from an RDSP for a non-resident can be complex. Depending on your new country's tax laws, these might be taxed differently than they would be in Canada. With the US, they do see the RDSP as a foreign trust, and thus there is taxation on the withdrawal of money earned within the account. However, the principal amount in the RDSP has already been taxed by Canada when it was contributed. Thus, that portion of the account is not taxed. You will absolutely want a U.S. tax professional to assist you through the complication that is the RDSP. Costa Rica gives you a free pass if you are a non-resident, but once again, it gets similarly complicated if you are a tax resident. 100% you'll want to talk with a local tax professional to sort out your taxes, especially in relation to an RDSP. It will pretty much follow a similar trajectory to the U.S. process, but you still need that assistance. The non-registered or personal accounts come with no extra benefits or frills. Non-registered accounts are, well, they're straightforward when you're in Canada. You pay taxes on interest, dividends, and capital gains as they're earned. However, when you move abroad, the tax scenario changes. The main issue for expatriates is the potential for double taxation, paying taxes in both your new country and Canada. If you move to a tax treaty country, the treaty will often contain provisions to avoid that double taxation. Residents of non-tax treaty countries need to understand both the tax implications in their new home country and how those align with Canada's system. It's all about finding where any double taxation occurs and figuring out if there are any strategies to mitigate them. Once again, that local tax professional will be able to help you with that big time. This video was a general overview of how your investing accounts look if you move out of Canada. As always, do the math before you leap. And consulting with a tax professional trained in the destination country's tax laws can make all the difference and help you choose a destination that works for your taxes. Well, let's continue that learning journey. Check out this video on the RRSP meltdown, and I will see you in the next video.